It's been a solid 8 weeks for equities. S&P is up 24% from early April lows and now faces the big test of the February highs, which were all-time high at 61.47. A notable feature of the current market rally has been a consistent wall of worry. Most market strategists have turned from being very optimistic at the start of the year to being pessimistic, and be it on tariffs or the state of the economy. As far as the economy is concerned, on reported data, there are still very limited reasons to worry about a number of variables have fared better, and any tariff impact is not yet in the numbers. Doesn't mean it won't be there, but it's not there so far. Let's look at a few charts, starting with the consumer. Retail sales data, which is expected also to be reported in this coming week, do not show any particular stress. The last two readings have actually been robust at 5.2%. Consensus for May is a moderate deceleration, but still reasonably elevated at 4.9%. Even consumer confidence, which had been trending down, is now basically showing a rebound, as we saw in the report that came out on the Friday gone by. Now, while we appreciate that front loading of a lot of purchases ahead of the uncertainty surrounding what the tariffs may or may not do would probably be distorting the data. But the reality is that it's the job market that has remained relatively robust and supported consumption. So let's look at labor market indicators. Unemployment has been steady, and as have been payrolls. Now we know that there is constant revision to this data series, and there's always question marks about this data series, but the trend is what matters, and that has so far not shown any substantial shift. To round out the consumer part of the economy, if you look at housing, sure, there has been some weakness, and that softness is understandable given the elevated mortgage rates. And to that extent, we have seen some deceleration in housing, but again, it doesn't seem to be incrementally worse. Now, moving to inflationary trends, and that I think has been a very interesting one. Despite continuous concerns from what tariffs may do to inflation, readings have not really been a cause for alarm. Now, one might say that tariff impacts are, perhaps it's too soon for the tariff impacts to be felt, but what has also helped inflationary trends is the fact that oil prices have been declining steadily, well, until last week. And while it's customary to exclude volatile energy prices from core inflation measures, the reality is that a persistent trend in oil prices eventually feeds into core measures as well. And the flare up in the Middle East that we saw, which saw a big spike in oil prices, it's difficult to say whether this is going to be sustainable or not. That really is debatable, but is it a risk? For sure it is. Which then gets us to the FOMC, which is coming up this week. The probability of a rate cut is pretty much close to zero, and rightly so. The Fed has been concerned with future inflationary impacts from what tariffs may do, and yet does not have enough weakness in either consumption or the labor market to justify a rate cut, at least for now. Market expectations have consistently been pared back, and the next rate cut, as far as the futures are concerned, is only going to be in September, and one more by December. So really two more rate cuts, but we think it's going to be a lot more data dependent, and particularly with watching what the labor market is doing. Unless there is a huge amount of weakness, I don't think the Fed's going to act. So while there's plenty to worry about the data, the reality does not match that worry for now. But prices is what we focus on, because prices move on expectations of future fundamentals. And while tariffs are a problem in themselves, it's the uncertainty that's the bigger one. In the latest version, the president is now threatening to send letters to countries outlining tariffs. I don't know, maybe he's just fatigued of all the negotiations, or maybe he's just not willing to do any more deals. But the reality is, volatility and uncertainty are back in play. After the fastest compression since peak in early April, VIX is rising again, both reflecting the uncertainty on tariffs as well as some of the geopolitical tensions that have arisen. So, what is the price action doing? Ultimately, that is the truth of the tape, and that is critical. As trends go, S&P is still in an uptrend with higher highs and higher lows. While the bid for all-time highs of 6147 may have been rejected last week, it's yet to be negated. And that I think is very important to note. Multiple indicators do suggest some form of a consolidation period. One could call it distribution 2. So unless we see a break below 5900, which would threaten the uptrend, or we see a breakout into new highs, we think the market kind of goes a little bit in hibernation and sideways, but perhaps with an upward drift. Either way, the setup is favoring a larger move one way or the other. Rotational trends are interesting. They seem to support a little bit of a defensive bias. Technology has been and still remains in an outperforming mode, but it's looking a little bit fatigued. At the same time, healthcare, which has been substantially beaten down in absolute and relative terms, is showing positive momentum. In fact, on screening parameters, we're seeing big pharma showing a relative strength, and that is across multiple stocks from Eli Lilly to Pfizer to Merck. They all have positive momentum. Now, should defensives catch a bid, what else is going to move? We're likely to see gold, which has also been consolidating, to resume its uptrend. And after uh, another period of consolidation for the last many weeks, any decisive breakout above 3450 will promise more upside. So, where does that get us? In summary, the data thus far has been supporting the up move, which has been pretty solid and has climbed a wall of worry. But price action is something that we continue to watch. There are some chinks in the armor, but we just do not have enough evidence to classify a change in trend, a breakdown below 5900, or a breakout past the 6150 level will really set the tone. Patience will be a virtue. For now, we see healthcare as an opportunity, and gold will be one should we get past the 3450 level on a decisive move. Like, subscribe, and share. Good morning. This is Sunil Garg from Lighthouse Canton.